Now you may start. Sapna, we have started a webinar. Welcome everybody. Sapna, you may take the platform now.
Yeah. Hello everyone. Good afternoon. A very happy Women's Day to all you lovely ladies out in the audience, and a warm welcome to all our viewers. Welcome to this Women's Day special, and this is on demystifying financial investments for women. So traditionally, we have seen in a typical, division of roles, men have basically handled the family businesses, the family finances, and the investments, whereas women have taken care of the children and managed the household. But over the years, these boundaries have greatly diminished. And from a women's perspective, in terms of overall confidence, self-esteem, and the ability to handle difficult situations, I think it has become extremely important for women to have at least a basic understanding of this crucial and critical domain. So we at HDFC Securities Limited have launched an initiative to educate women and create awareness and empower them in this field. So I have here a presentation which I will be taking you through, and after this we can take a few questions and make the session a little more interactive through a Q&A. So over the last few decades, women have been making great strides in various fields, be it politics, be it international affairs, science and technology, media, finance, you name it, they have been, making great achievements and leading from the front. These here but are a few handful of women who have actually come into the limelight. But there are hundreds and thousands of women out there, facing challenges every day in their respective fields, in their communities, countries, facing these challenges and overcoming them and emerging successful. However, when it comes to handling financial matters and taking financial decisions, it seems that we still have a very long way to go. In a recent survey that was conducted by UBS at a global level, it was found that 82%, and these are really startling results, 82% of the women globally felt or thought that their spouses knew a lot more about finances, and consequently, 77% of them did not make their own long-term financial decisions. Closer to home, in the Indian context as well, the situation is not very different. In fact, it is very ironical that the finance minister of the largest democracy of the world is a woman, yet 56% of the women in the country have no idea as to the financial investments of the family. In fact, half of them have no idea about the insurance policies, be it life insurance or health insurance, and 1/3 of the women felt completely incompetent talking about financial matters. So high time something needs to be done about this, right? In fact, if I talk about the lockdown, I think the greatest learning or the one key takeaway has been that if we exert ourselves a little bit, there's a lot we can learn. And for instance, the men in the family managed to learn how to do the household chores, be it the cooking or the cleaning. Our senior citizens and the elderly were forced to learn technology, to leverage on technology, and now they've all become very savvy with Zoom and using e-commerce platforms. In fact, even the women, there are a whole host of them who became self-made entrepreneurs working from the house. So it's all about learning new capabilities and learning new skills. And what is to gain? If we are a little more financially savvy about our investments, the first thing, of course, is that we have a better self-image. We gain a lot of confidence. As we learn more and more on the subject, we read, we ask questions, we probably, we can have a financial advisor, we talk to them. So there is a better understanding of the investment options that are available to us. And over a period of time, if we are able to use this knowledge to our advantage, we can actually get better returns in our portfolios. Another important thing, yes, fulfillment of goals. We all have aspirations and desires. I may want to buy the latest, handbag or, fashion jewelry. So what, be it, yeah. But apart from that, on a more serious note, I think financial planning actually helps us achieve all our goals. So in fact, there was a client of mine a couple of years back, 3 years back, so to speak, and she came to me and she said, Sapna, my husband and me are both making pretty good money. She was in the legal profession, and her husband had a senior position in marketing in one of the IT companies. And as I said, they both were making a good amount of money. But if you had to see their portfolios, it really didn't reflect that. And she was very concerned because she says, I have a child and I need to plan for my child's education in the future. And they were also planning to move to a little, bigger and better house. So we actually sat across the table, understood the entire budgeting, and actually created a financial plan and a strategy for investments for her. And happy to say, 3 years down the line, she was able to make a substantial payment towards the down payment of a new house. So that is the importance of understanding your finances. Another very important consideration is the ability to handle unforeseen events. So when we are taking care of our finances, we make sure that we have contingency funds in place in case there are any family emergencies and we need to use these funds. Awareness about where our investments lie can really hold us in good stead at this point of time, as compared to someone who's completely clueless about where the family investments lie. In our old age as well, as we grow older and we need to plan for our retirement, we must understand that it is important to be self-sufficient in our old age as well. And in today's scenario, where life expectancies are going up, where the joint family system doesn't really hold anymore, everybody lives in nuclear families, it's really important to create a retirement corpus that can see us through our post-retirement years. So before I actually touch upon, a portfolio and how to go about constructing a portfolio, this is an important concept that we must all understand: the power of compounding. So what does it mean? All of us have the tendency to postpone our decisions, and a lot of these are our investment decisions. But we must understand that by postponing our decisions, we actually lose out on opportunities to grow our wealth. Let me give you an illustration out here. So assuming I'm planning for my child's education, which is around 10 years down the line. Now I've just taken a rough estimate here of around 10 lakhs for the goal. It could be much more depending on where the child wants to study, in India, abroad, what is the course that we're looking at. But just for calculation purposes, I'm looking at a corpus of around 10 lakhs, which I need 10 years down the line. And looking at trends in inflation, as far as education is concerned, I've taken a 10% inflation. So what I need today is 10 lakhs, but 10 years down the line, this amount actually grows to 26 lakhs. And, if I have to actually get ready or prepared for this goal, and I start today, I need to make an investment of around 11,000 per month, if I do it in monthly installments. But if I postpone this goal, or if I postpone the planning for this goal by 5 years, the amount actually grows 3 times. And instead of having to save 11,000, I would need to save close to 32,000 per month just to achieve this goal. Similarly, if I need to accumulate a retirement corpus of say 1 crore, if I start my investments just 5 years prior to the goal, I would need a huge amount of 1,24,000 every month to reach this target. However, if I start well in advance, the amount could be as small as 3,000 per month if I have 30 years to plan for the goal. So this is the magic of compounding, and this is why I'm emphasizing on the point that we need to start our investments today. So now talking about, actually how we can go about constructing our portfolios. I have a very simple analogy out here. So all of us in our day-to-day lives, we can all relate to this. When we are planning the meals for our family, we make sure we have items from every food group so that there is, variety and there is adequate nutrition. Similarly, when I'm constructing my portfolio, I must make sure that the portfolio is equally diversified and has investments across different asset classes. So what are asset classes? Asset classes are nothing but the building blocks of our portfolio. So today the investment landscape has a whole host of investment opportunities. Many products are complicated. The minimum amount is quite high. For instance, you may have alternate investments funds. There are hedge funds. There are complex structured products. So these are all investment opportunities, yes. But for the sake of creating a core portfolio, I think we can narrow it down to 4 main asset classes: debt, equity, gold, and real estate. Let's get a slightly better understanding of each of these asset classes. So debt or fixed income is among the safer asset classes that we can invest in. Typically, this would mean investing in, say, fixed deposits of your bank. There are bonds. It could be tax-free bonds, RBI bonds. There are corporate deposits also. You can invest in debt through government saving schemes like the PPF, NSC, Senior Citizen Savings Scheme. And of course, you also have debt mutual funds. So debt is basically characterized by some amount of security and stability. Once we park a certain amount of money in a debt instrument, we tend to get regular payouts, which are in the form of interest or coupons. These may come to us monthly, quarterly, annually. And at the end of the tenure or at the maturity period, this amount or our capital that we invested into the instrument will come back to us. So you can see that, yes, the returns are more or less fixed, and we get regular interest payouts also. So there is a certain amount of capital protection here. And hence, it is typically for this reason that the returns from debt are slightly on the lower side. So if we actually want to grow our portfolio and if we want to create wealth, then we must have equity. So what is equity? Equity is nothing but buying a stake or taking ownership in a company that is listed on the stock exchange. Now, if you're looking at equity, we can take, our exposure to equity in different ways. We can buy directly stocks if we are, savvy. We are following the markets on a regular basis. We understand the fundamentals of different companies, sectors, etc. Then we can invest into equity directly. However, if we are not so savvy and sometimes we don't have the time, then it is a good option to go through mutual funds. So what is a mutual fund? Nowadays, it's become a very, very important and core part of the portfolio. It is nothing but a pool of investors' money, and this is professionally handled and invested into stocks. There are various advantages, of course, to investing in mutual funds. As I said, there is professional management out there. So the fund manager takes decisions on when to invest in certain stocks or sectors, when to exit, and overall how to manage the portfolio. Then, of course, it's a very transparent instrument. You know the value of your investments. The NAVs are published on a daily basis. There is a lot of liquidity. You can redeem your investment anytime you need the money. All you have to do is send in a redemption request, and within a couple of days, you have the money in your bank account. Returns have been very good. And over and above all this, SEBI regulates the mutual fund industry very closely, and it ensures that the investors' interests are protected at all points of time. So this is about mutual funds. Apart from that, we have PMS and small cases. And all these offerings, actually, all these investment options are actually available on your HDFC Securities portal, and any of these investments can be done digitally. Now, this is about these investment products, but just speaking a little more about equity, we know a lot of investors are actually averse or wary of investing into equity. And, some of them have actually seen a lot of their wealth wiped out. So this could be due to bad decisions that they have made. Yes, agreed. But I have the graph of the Sensex out there, and you can see this graph from 2000 onwards till date. And you can see that it has definitely not been a smooth journey. It is not giving you linear kind of returns that debt can give us. But, if you see there have been corrections like say in 2008, during the global financial crisis, there have been minor corrections in 2013, 16. Last year, we had a very big correction at the onset of the COVID pandemic. And we saw markets fall very sharply at that point of time. But if you see the overall trajectory, it has always been upwards. So where markets were, in the range of say 5,000 on the Sensex in 2000, today we have touched 50,000. So though the ride has been volatile, it is important for investors in equity to understand that equity is an instrument for the long term. And we must say invested for the long term to reap the benefits of investing into equity. Gold. Yes, this is I think a favorite among the women out there. We buy a lot of gold, and we're fond of wearing jewelry. Yes, India is in fact among the largest importers of gold in the world. But gold also has a special place in our investment portfolios. So gold happens to be a safe haven, it holds a lot of inherent value. So typically when there is a lot of uncertainty in the markets, when there is a lot of panic, investments move out from equity and move into gold. So gold acts as a hedge in that sense. And we recommend that investors should have gold to the extent of anywhere between 5 to 10% in their portfolios. How do we take this exposure? We can buy physical gold, which is in the form of bars and coins. But here there is a certain disadvantage in the sense that you have to actually, there are at times transaction costs involved, and you actually have to physically store this. So to overcome this, we now have gold that we can invest in financially. And this is through the sovereign gold bond funds or through ETFs and mutual funds. Now, SGB is, of course, these are issued by the government of India, so they're extremely safe. It's an 8-year product, so there is a lock-in of 8 years. But there are two distinct advantages of investing in this instrument. It is, of course, pegged to the price of gold. So depending on the movement of gold, the price moves. But the two advantages are, one, that it gives you a 2.5% interest payout every year, which no other instrument, gold instrument, gives you. So over a period of 8 years, this actually adds an incremental value of 20% on your initial investment. And secondly, which is another important advantage, is that the investment that at the time of maturity, the returns that you make on your investment, these returns are completely tax-free. So that's the advantage of SGB. But as I said, there is a lock-in. So if you do not want to stay invested for 8 years, we have instruments that are very liquid, which are nothing but gold exchange traded funds or ETFs, or mutual funds, which again you can buy online, and in case you need the money anytime, you can easily redeem this and exit from this investment. Real estate. Yes, this has also been a favorite for us Indians, and over the years some investors have made humongous amount of money in real estate, no doubt about that. But there are some distinct disadvantages to owning real estate. There is, of course, a very heavy investment amount that you need to put in, especially in places like Mumbai. Secondly, there is some costs involved in maintenance and upkeep, which can be very high. And of course, the returns have not been very great. It's just been about 3 to 5% in terms of rental yield. But over and above all this, your money gets locked into an asset which is relatively illiquid. Yes, it does give you passive income later on, but the liquidity is, kind of stuck over there. So to overcome typically these disadvantages, we now have REITs that investors can put their money in. These are relatively newer investments. They've been around only for say 3 years in our markets right now. And it is quite similar to a mutual fund whereby investors pool in money, and the money that is so collected is invested into A-grade commercial properties. So the 90% or I should say 80% of the amount that is collected has to be put into properties which are already yielding some kind of return. They are completed properties, and 90% of the returns that are generated have to be passed back to the investors. So we have seen that over the last 3 years, these instruments are able to give us a kind of a return of say around 7% per annum, which is pretty good. So yes, now that I have covered the 4 main asset classes, how should I now decide how much do I allocate to each of these? So what is the asset allocation that I should have? Now, a very simple way of figuring this out is by assessing your risk profile. And typically there are a lot of risk profile tests by which we can understand this. So you could be conservative, balanced, or aggressive. A conservative investor is someone who is typically not comfortable with volatility, who prefers safety, and hence we take a larger exposure to debt in the portfolio. A balanced person can take a kind of a 50-50 kind of exposure, and an aggressive investor is someone who can kind of stomach volatility, is also expecting higher returns, and hence we can take a higher exposure to equity in their portfolios. Now this is a kind of a very simplistic kind of understanding of how asset allocation can be done. There are a lot of complexities involved, and it's always better to have a face-to-face discussion with your financial advisor before you do this. There are also other factors to keep in mind, and typically we call this the SLR matrix, or the safety, liquidity, and the returns. So safety is nothing but protecting a certain amount of your corpus. So suppose you have a goal or a commitment, financial commitment, over the next couple of years, you have to make the down payment of your house, or your child is going to study and you need to put down some money for that. So typically the corpus for this is put aside in debt. Similarly, you need adequate liquidity to make these commitments as and when they come up, or when these milestones come up. And returns is, what is your returns expectation? So depending on these 3 factors, we are able to decide what is the allocation we need to make in our portfolios. Just to give you a broad understanding and a perspective on the kind of returns these different asset classes have generated over the last 30 years, so you can see that equity has done well, but an important aspect here, and I would like you to focus on the green bar on the right over there, and that is inflation. So inflation is a kind of a silent devil in the room, and it really creeps up upon us year on year. So if 7% has been the inflation year on year, and our deposits or our fixed deposits or our debt instruments have been able to generate 9%, these have generated a small real return, the return over and above inflation. However, if you see, equity has beaten inflation by a good margin, and hence that is why I say it is necessary to have some equity in your portfolio. Insurance. Again, this is a very, very important part of the overall financial portfolio. So this insurance, or the various types of insurance that we have, they provide a kind of a safety net, and they protect us against losses that we may have from unexpected events. Life insurance is a very important consideration. Every member, be it a husband, a wife, anybody in the family who is contributing to the household expenses, must take adequate life cover. It's extremely traumatic to lose a loved one, and we must make sure that our families are well protected in case of any such contingencies. The best way to take a good life cover is through a term policy. So you get a reasonably large cover by paying a small premium every year. Apart from that, health insurance is very important. We've all seen even during COVID and otherwise also that medical expenses in our country have really been going up, and we must all take adequate medical cover, be it young or old. Every member of the family must have a medical cover, which can be taken either in the form of a family floater, individual floaters. There could be critical illness covers. You could also have a combination of base and top up. So these are various options that you can consider, but important that every person is adequately taken care of. And apart from that, yes, we have our assets, which in the form of house insurance and motor insurance, we must protect. Last but certainly not the least, succession planning, which is an important responsibility. As we grow and as our wealth grows, it's very important that we make sure that we have a will in place so that we avoid unnecessary unpleasantness between family members and litigation in the future. So a will is a very simple and straightforward instrument which can do this. Apart from that, in case we have large holdings, complex family structures, or special situations in the family, sometimes we may have a child with special needs. In such cases, a trust would be the preferred structure for succession planning. In addition to that, we must make sure that nominations for all our investments are in place so that we avoid undue legal hassles in the future. So with that, I kind of come to the end of my presentation. Of course, education is the key. Each of us must endeavor to go out, read more, talk to more people, ask questions, learn a little more about financial investments so that we can add one more feather to our cap. Thank you so much, and happy Women's Day again. We can take queries. If any of you have queries, please do use the question mark icon on your window to type out your queries. So we have the first question out here. Savita says, will a recording of the webinar be available for attendees afterwards? Yes, I'm sure we will try to upload this on social media so you can access it. Savita also says, requesting your help in understanding SGB as opposed to other investments. So like I mentioned, Savita, SGB is, an investment or a bond that is issued by the government, and it is issued almost every month now. And the two main advantages, as I said, are you not only get an interest payout on your investment in SGB, but your returns at the end of the tenure, if you stay invested till the end of the tenure, which is 8 years, are completely tax-free. Apart from that, as far as the price of gold is concerned, that will be reflected across all investment instruments, be it SGB or mutual funds or ETFs or even physical gold. So the price of gold, the investment will be pegged to that, so that will be similar. It's also important to understand that typically gold moves in cycles, and we saw from probably around say 2012 to 2017, 18, that there was actually really nothing happening in gold, and the price movement was very, very flattish. And suddenly from 2018 and 19, and then with the onset of the pandemic, we've seen gold prices shoot up dramatically. So again, as I said, gold is a safe haven, and the prices tend to move cyclically. When there is panic in the markets, money moves into gold as an investment, and hence we should not expect gold to go up regularly, but it is cyclical in nature, and over the long period of time, generally we have seen that gold prices have always gone upwards. Nishigandha Sharma asks, how do we invest in equity? What are the different options? As I said, Nishigandha, there are various ways of investing in equity, but typically we can take exposure to equity in three different forms. One is investing directly through the stock market into the stocks and shares of companies that are listed there. There are blue chip companies in different sectors. There are sectors like FMCG, which is nothing but consumer goods. IT sector, you have banking. So there are different sectors that we can take exposure to. We must diversify across all sectors so that we reduce the risk in our overall portfolio. Diversification is a great way to reduce risk. And apart from buying shares directly, we can also go through mutual funds. We can go through PMS or portfolio management services, or we can also have small cases or invest in ideas. It is referred to as invest in ideas on our HDFC Securities platform. These are all different ways of investing in equity. It all depends upon our knowledge of the stock markets, our knowledge of the fundamentals of companies. If we do not have sufficient knowledge and we cannot monitor our investments regularly, it is a much better option to go through mutual funds. So I have a couple of questions on real estate, Hema and SD. How can we invest in real estate or REIT? So these are listed on the stock exchange, Hema. You can buy these like you can buy stocks. The minimum amount is anything. If you apply in the IPO, it is around 50,000 or so. But now they are freely traded. Once they are listed like a stock, they are freely traded. You can buy into them, and once you buy them, they will sit in your demat account. So it is important that you open a demat account. So whenever you want to buy securities over the stock exchange, be it shares or be it REITs or ETFs also, you need to first make sure that you have a demat account in place. And once you buy these these investments will be held, or they will stay in your demat account till the time that you sell them. REIT, as I said, you can buy them freely and sell them freely. And if you stay invested in REIT, there is a payout that they give you, which works out to around 7% per annum. As of now, this is the kind of payout. This is typically the rental income that these properties generate. This rental income is distributed to all the investors, and over a period of time, there could be some capital appreciation also of those properties. And over a period of time, the REIT value or the issue price can also go up. But again, that is a long term. Mary asks, I want to know the right time to exit a blue chip stock. Thank you. So Mary, why would you want to exit a blue chip stock unless you really needed the money? I think blue chip stocks, by the name itself, it means that these are really strong companies. They have been around. They have a large market share, and they're very, very well established. So sometimes these blue chip companies, if you're referring to stocks in certain sectors, some sectors perform on a rotational basis. At times FMCG will do well, at times IT is likely to do well, banking does well at other times. So just because the price remains stable for a certain period of time does not necessarily mean that we need to exit from these stocks. You need to exit only if either the fundamentals of that company are not good, or the sector is showing some major changes by which you need to move out of that sector. Or the third thing is if you actually need the liquidity or the money for your own purposes. Otherwise, if the stock that you have invested into, the blue chip stock that you refer to, if it is a good stock, then I would advise you to stay invested for the long term. Trading on the market through your application, through your app, is there any guided seminar for it? How do we go about identifying which mutual fund is doing well? This is a question raised by Deepa. So Deepa, yes, thank you for your question. So we have a very, very extensive portal, our HDFC Securities portal, through which you can make investments into equity. As I said, even in small cases, which is referred to as invest in ideas, you have SGBs, bonds, a whole host of instruments. And we have a lot of research reports also that we upload on stocks, on sectors. So you can go through these and understand them. You can even contact your RM if you need any further assistance on this matter. But basically, our portal is very, very well equipped, very has a lot of depth in terms of the content that it provides, and the analysis of all these companies is the quarterly results. Everything are uploaded from time to time. All you need to do is get onto the site and explore these different options. And if you, as I said, if you need any further help, please do get in touch with your relationship manager. So Varsha again has a similar question. She says, is there any material available which can guide us to invest in shares using DMAT, and how to select correct mutual funds? So the HDFC portal, as I mentioned, has a lot of information regarding individual shares and individual companies. So please do read those reports. But if you're not an investor who's regularly in touch with stock markets, then I would definitely advise you to go through mutual funds. We also have mutual funds on our HDFC portal. We have a ranking of mutual funds based on whether they are large cap, mid cap, multi cap, flexi cap, different categories of mutual funds. The best performers are available over there, and you can take some advice from your RM, as I said, or you can even go through those mutual funds, see their past track record, see the kind of portfolio, and accordingly take an investment call on those mutual funds as well. Please do seek the help of a financial advisor before you make important investment decisions. Savita has one more question. How can one reinvest dividends back into shares? We can either do that manually, Savita, or we also have the facility to do an SIP into shares. So SIP is nothing but a systematic investment plan. So most of us here who are working, we have a regular income month on month. A lot of that goes in our expenses, and some component of it, which is our savings, we do need to set this aside for our future requirements, for our future milestones and our goals. So a good way to do that is go through the SIP route. Now, as I said, SIP stands for Systematic Investment Plan. And what we do here is that we decide based on the surplus that we have every month to invest. We decide a certain amount that we invest automatically into these mutual funds, or we can even do SIP into shares. Now, what happens is over a period of time, there could be fluctuations in the prices or the NAVs of the mutual funds. And in case we do see the NAVs coming down, that is actually a good way of averaging our overall investments. So that is why we call it as rupee cost averaging. And over the long term, so there are some people who say, is this the right time to invest? Markets are at all-time highs, and there is a lot of nervousness about that. But SIP actually helps you to overcome all these issues. So when we do an SIP, which is over a period of say 2 years, 3 years, or even longer, SIPs can go on indefinitely, we actually average out the cost of our investments. And if we've seen, if our SIPs were in place last year when the pandemic actually happened, and the market dropped, our SIPs were actually able to take great advantage of these lower values, and the SIP returns have improved dramatically, you know. So SIP is an excellent way of investing into shares or into mutual funds. Please avail of these, especially for all working women who have a regular income and who have a surplus that they would like to invest on a month-on-month basis. So Vikram has a question: what is the ideal way to calculate the cover for life insurance policy? Vikram, very good question out here. And typically we do say that you need to take a life cover which is approximately 20 times your income, annual income. But at HDFC, we also have a very detailed way of understanding the overall life cover required, and this is known as a need-based calculation. So here we actually calculate what is the present value of all your future expenses, of all the important household expenses that you will have in the future. So we calculate the present value of that. In addition to that, we also add the cost of your goals. So if apart from your regular household expenses, you need to set aside something for your child's education, which is an important and hygiene goal. We add the value of the cost of that goal, and we also add the value of your liabilities. So if you've taken a home loan or if you've taken any other loan, we've also factored the cost of the liability into the life cover. And after that, if you have any existing investments, we deduct those investments. And if you've already taken another insurance policy and you have some existing life cover, we deduct that value as well. So that way it is a completely need-based evaluation of what is the life cover that you need. But as I said, if you just want to take a big, ballpark figure, you can just, do a 20 times calculation of your annual income. One more question here on blue chip stocks. Are blue chip stocks tax efficient instruments? So not particularly blue chip stocks, but any investment in equity is relatively more tax efficient compared to your investments in debt because the tax treatment is different. So for investments in equity, be it either directly into stocks or mutual funds, the investment cutoff of 1 year is considered for it to be considered either as a long-term investment or a short-term investment. And whatever gains you make, suppose you exit from that within 1 year, they are considered as short-term capital gains. But if you hold on to them and you exit post 1 year, or you can hold on to it for as many years as you want, then they are considered as long-term investments or long-term capital gains beyond 1 year. And the tax slab is like 15% for short-term capital gains and 10% for any gains that you make post 1 year. As compared to that, our tax treatment for debt is different. For debt, the time period is considered as 3 years. Whatever exits you make out of debt are, within 3 years are considered as short term, and these are taxed as per your marginal tax slab. And whatever debt investments you exit after 3 years are considered as long term, capital gains from debt, and those are taxed at 20% after indexation. So Apurva Patil has a question. She says, I am 21 years old. What should I invest in? So great question, Apurva, and thanks. I'm sure there are a lot of viewers like you at your young age. And if you have already started working and you are, making an income, as of today, I would suggest you definitely go through the mutual fund route. And I mentioned a little earlier that you can use the SIP route to invest into mutual funds. So you can set aside, maybe choose 2 to 3 funds depending on the corpus available or the amount that you have, divided between these two to three funds. You can have one large cap fund, you can have a mid cap fund, or you can have a flexi cap fund. So large cap funds will invest in the blue chip stocks or the large cap stocks. Mid cap funds will typically invest in the slightly smaller companies or the mid cap companies. And a flexi cap fund is a fund where the fund manager can decide how to diversify the portfolio across large caps. It is the fund manager's discretion to decide how much of large caps and how much of mid and small caps to keep in the portfolio. So you can typically break up your investment into three different types of funds to start with. You know, as you grow and as you have a larger surplus to invest, we can add one or two more funds into this. We can look at other options as well. Since you're young, you have a very long-term investment horizon. So definitely equity is the best way to go. As you work, you will also probably have contributions to EPF and you know, certain other debt instruments. So on the side, your debt portfolio will also build, and it is a good idea to always have some kind of debt in your portfolio, so that your portfolio is balanced out and not you know, diversified, and not only in one particular investment. Apart from that, Apurva, do keep a small contingency fund. You can keep that, you know, in your savings account. You can invest that into liquid funds, or you can even have a sweep in FD. Please keep a small contingency fund for, you know, any kind of emergencies or contingencies that you may have in the future. I think we have exceeded our, you know, time, but if you have any other queries, please do write into me. You can write in at sapna.punjabi, sapna.punjabi@hdfcsec.com, and I will revert to your mails. Thank you all for being here today. Really happy to interact with you all. Some really great questions, very, very pertinent questions. And I wish you all the very best in your investment journey.